All right. Good afternoon, everybody. Uh, this is Landon here for our monthly market update. I will give give people a few more minutes to join in on the meeting. So I think we had a few that registered, but I'll give just another minute before I jump into it so that everybody can participate if they want. Hopefully everybody's having a great summer so far. Tell you what, we can't beat the weather, at least out here on the West Coast. I know the East Coast has been getting pounded with the heat, and the South is getting pounded with the weather right now, but out west we've been a little bit fortunate, so knock on wood. Okay. Well, it's 11:01, and in the interest of time, these sessions are recorded, so anybody can go back and watch them in the future if they are able to log on and participate in our live session. So I'll go ahead and get started. Welcome to our July monthly market update. This webinar continues the monthly sessions that I conduct to discuss what's happening on the global and domestic economy and the markets, stock and bond markets, to provide you, our clients, and anybody that's interested an opportunity to ask questions and discuss what's happening in the real world. In the email invitation, you should have received the market update quick hits, which just is kind of a summary of what's going on in written form that you can read. You're also welcome to watch the video that is published by Chris Fasciano, who is Commonwealth's chief market strategist. He puts out a lot of good information, but provides a nice monthly video that summarizes their perspective on things. So you're welcome to watch that. The link is in the email as well. That information is also on our website. So, all right. Just as a highlight, like I said, much of this information, both Chris's video as well as this video, is recorded and published on our website under events. You're welcome to go back and look at the previous videos. I try to keep the current one fresh, but we also have a library of them as well if you're interested in looking at a particular month or year. Okay, so let's get started. I'm going to summarize the quick hits for you, just discuss any factors that I think are worth mentioning, and then we'll open it up for any questions if there are any. So to start off, here is the monthly market quick hits. Says against a backdrop of easing geopolitical risks and strong earnings growth, markets rallied strongly across the board. The S&P and Nasdaq turned in their strongest quarters ever. I'm sorry, turned in their strongest quarter since the second quarter of 2020. Throughout the quarter, the U.S. and Iran moved slowly towards the signing of the Memorandum of Understanding to potentially end the war in the Middle East. As a result, the benchmark U.S. crude price declined more than 30%. And then below that, we had beyond the headlines, the market rally gains liftoff. That's a little bit of a tie on the SpaceX IPO. Fixed income update, bond investors relieved by the progress in the Middle East. Geopolitical and economic update, we have the reopening of the Strait of Hormuz becomes key. We'll talk about that a little bit more. And then looking ahead, we've got other cross currents worth monitoring. So let's look at how the markets did for the month of June. And again, we're always kind of looking at what happened in the previous month. I know we're sitting right now at the middle of July, but you can kind of see the results for the month of June, and I need to pull the chart up a little bit because it's a little bit hard for me to read. And hopefully everybody on the call can see it. Okay. So during the month, the Dow Jones gained 2.43%. So again, the Dow Jones reflects the 30 largest stocks in the market, whereas the S&P 500 and the NASDAQ Composite both saw declines. And some of that is driven by the fact that we saw some of the Magnificent Seven drop off. We had a little bit of a tech sell off, but overall, they're still doing well. The MSCI, which is the international index, saw a slight pullback of just under 1%. And the U.S. aggregate bond index, the Bloomberg U.S. Ag, saw a slight positive return, but relatively flat for the month. So overall, not a terrible month as far as the markets are concerned. If we look at where we stand year to date, a little bit of a better picture. As everybody's probably aware, so far this year has been a pretty strong year in the markets so far. So through the end of June, the Dow is up 8.8%, almost 9% for the year to date since January 1st. The S&P 500 is up 9.5%, almost 10%. And the NASDAQ is actually up 13%. So even after the June decline, we're still up 12.8%, almost 13%. So far, even after a little bit of a pullback, international is still the strongest performer so far this year with a return of about 14%. And bonds are still providing a positive return so far at just under 1% point, 0.62%. So we'll talk about that in a little bit. If we just zoom back out a little bit more, kind of look at how how we've done over the last 12 months. Okay, so let's see. Oh, actually, it looks like it's a duplicate of the previous chart, so we'll just ignore that for the time being. Let me just talk about what's been happening, just and what's driving all of that. Okay, so as I mentioned, June's was kind of a mixed month. I had talked about the fact that the Dow Jones and the Russell 2000. So the Russell 2000 is the benchmark of small cap stocks. Both of those showed increases, whereas the S&P 500 and the NASDAQ showed some declines, led by that tech sell-off. And it's a little bit surprising that bonds have kind of held their own because there's been some expectations about rising yields, and if you know anything about bonds, typically when yields rise, bond prices fall. So it's nice to see that they've been holding flat, even with expectations and slightly increasing yields. And I think the June performance is sort of indicative of that Wall Street mantra of sell in May and go away. So the fact that we've got a June kind of modest performance is actually probably to be expected. And now I did mention SpaceX. Let me jump to that. This is a chart of the SpaceX stock performance since its IPO, and you can kind of see it definitely came out of the gates strongly. I think it launched it, no pun intended. It came out at 135 and it popped up to over $200 per share, and in the first few days, and then it's kind of gradually sort of traced back to where it came out. That's fairly typical, not always exclusively, but it's fairly common for initial public offering stocks to kind of show this kind of a trend um, shortly after their starting date. So it'll really be kind of interesting to see how SpaceX does going forward over the next few months and years. So nothing saying that it's going to continue declining. There's still a lot of positivity around the stock, but it's not unusual for a stock that starts off after its IPO to see a little bit of retracement back to where it came from when it started. Um, so just going back to the summary here, I'm going to talk about a few other aspects that are impacting the markets and the economy. Regarding the economy, in the rest of the stock market, most of the indicators still point to a continued growth for the rest of the year. I know some people may be a little skeptical about that. However, corporate earnings are up almost 22% over the last 12 months. And earnings estimates for the end of the year are up 9% since their original estimates. So the fact that we've got corporate earnings at 22% over a 12-month period, which is roughly double what they normally are, even on good years, suggests that this is going to be or is a good year to be a corporate shareholder. And that holds well for what we might see over the next remaining 6 months of this year. Not only that, but those earnings have been broadly based. Most people have been focusing on the Magnificent Seven, those hyperscalers that are focused on tech and the AI revolution. Those obviously have been doing well, but the 493 stocks that represent the rest of the S&P 500 have also been showing earnings growth of 19% since the beginning of the year. So these earnings reports are broadly based and not just solely concentrated in those 7 stocks. So that is positive, and part of the pullback in the tech stocks may partially be attributed to the fact that some of the institutional shareholders, the pension funds and otherwise, are broadening. They're trimming their holdings in those concentrated positions and broadening their holdings in the rest of the market. So I wouldn't overly read into a decline in the tech stocks right now. We're continuing to see relatively strong economic performance. The May jobs report showed 172,000 new jobs created that month, and the previous months of March and April also saw revisions upward, with an average of 188,000 new jobs created over that 3-month period. So even so far, we are not seeing the AI robots take too many jobs. I'm not suggesting that that's not happening, but we're still seeing very robust job creation in the markets. And as long as we've got robust job creation, we are not in a recession. So there's no indication of an economic recession on the horizon as long as we are producing that level of new jobs on a regular basis. There are still some things to watch out for, obviously. Inflation has started to track back higher again. I'm sure everybody is acutely aware when they go to the grocery store. And that is obviously as a result of the energy prices, the higher energy prices tied to what's going on in the Middle East. And I know that there was some enthusiasm about the ceasefire, and that led to some declines in energy prices. But unfortunately, that appears to be over for now, as the Strait of Hormuz is once again locked down and energy prices have begun to rise again. So we'll see what the effect of that for for July will be. I would not. Energy is just one component of overall price inflation. It's an important component, but it's not the only only effect on prices. So we'll see how much of a drag effect that continues to have on our overall economy. So far, even through the beginning, the last couple of months of this conflict, it hasn't seemed to put much of a damper on the economy. The longer it drags on, I'm sure the heavier that those energy prices will be on the economy. But for now, it doesn't seem to have been a major drag on the economy. The higher energy prices and inflation have led some to predict that the Federal Reserve may raise interest rates rather than lowering them in the coming months in order to try to get inflation moving back to their 2% target. I'm a little skeptical as to whether or not they will do that. Generally speaking, the Fed's going to focus on um, increasing rates when the overall economy and inflation is being driven by more macroeconomic conditions rather than just one particular factor, such as energy. They could do that to put a little bit of a damper on the economy and ease up the price pressure related to energy. But I think they're taking a wait and see approach right now, especially with the new Fed chair, Kevin Warsh. So if we do see a rate hike, I don't expect that we're going to see probably more than one, unless we really start to see runaway inflation again. So that's just kind of a watch and see type of a situation. Another concern is the ongoing depressive consumer confidence index, which still suggests that consumers are in a full state of depression. Um, However, there's something that's a little bit off about that metric because consumer spending continues to be fairly robust. And as long as consumers are spending, even if they are feeling bad about the spending, that's a positive sign for the economy because something on the order of 60 or 70% of our economy is based upon consumer spending. So even if they feel bad about it, as long as they're spending, that's good for the economy. One thing that may be pressing on consumers' minds is the housing market, which appears to finally have hit a bit of a soft patch. I wouldn't say we're heading for a housing crash per se, even though home prices do continue to inch up, but we are seeing more houses on the market for longer periods of time. We're still seeing underbuilding across the country by for the number of new houses that we need. So that leads to basic supply demand dynamics that would suggest that as long as we are undersupplied, there's not going to be a housing crash. I think that the issue is that the higher mortgage rates that we're seeing, with mortgage rates ticking back up, has put a little bit of a stall in some of the plans for buyers. So those buyers that have cash, have some more negotiating room in the transaction. So I don't see mortgage rates ever getting back again to 2%, but I do think that it's reasonable for us to see once interest rates come back down back to in the 5% range, certainly is doable. So anyway, so going forward, energy is going to be the real wild card that determines how things end up through the end of the year. Fortunately, in the U.S. here, we're less impacted by the global oil supply, but we are not immune. And so energy is a global market. And as things impact Europe and Asia and the rest of the world, that also has a rippling effect back to us. So we are not completely immune from it, even though we are somewhat protected. As we wrap up here, the economy seems to be continuing its slow economic growth. We're continuing to see market volatility due to energy fluctuations and the other international conflicts. Those effects are being offset by strong corporate earnings. And while it would be completely reasonable to see a pullback of maybe 10% sometime throughout the next 6 months or 6 to 12 months, most of the fundamentals around the economy and the markets remain positive and pointing to continued market appreciation, and that's a good thing for investors. So I will let me jump to the end here. If there's any questions anybody might have, I'll leave this open for a second. All right. There are no questions. Then I will tell you what's coming up. Here's what's coming up in the next month or so. So our next session on next financial planning topic session is titled "So You Want to Be a Landlord?" This is financial planning strategies for real estate investors. So if you have rental real estate or are considering investing in investment real estate, this is the session for you. We'll be talking about pros and cons of owning rental or investment properties, and how that affects and ties into your portfolio, your allocation, and your financial plans. Okay, so that's what's coming up July 29th at 12 to 1 p.m. Our next monthly market update will be Wednesday, August 12th at again 11 a.m. So feel free to look for the invitations for either of those sessions. As always, you're welcome to find any of my previous videos on various financial planning topics under the events section on our webpage by clicking the watch the recorded video link. If there are topics that are of interest to you, you'd like me to present on, just shoot me an email or leave me a message, and we'll see if I can get one of those scheduled for you. I will also note that the July session, I'm planning to do a presentation on cybersecurity and protecting yourself from scams and online predators. So keep an eye out for the invitation for that. But unless there's anything else, I will say thank you for joining me, and I hope you have a wonderful July. Take care, everybody. We'll see you on the next one.